Hi there, I'm Dean Heskin, President and CEO of Swiss America Trading, and thank you for tuning into our podcast, The Secret War on Cash, where we take an in-depth look at some of the different changing aspects and dynamics that are constantly taking place here in not only our economy, but around the globe. I have with me my co-host, Chris Agelastos, fresh home from Georgia, actually. Welcome back, Chris.
Yeah, thank you. It was a nice time, but it is good to be home. Get back into that normal routine.
You're there with your wife and your daughters. Did they have a good time? Look, I saw a couple pictures. Looked like they were enjoying themselves.
Yeah, it was great. That's really one of our first trips to the South where we spent any time. So it was a lot of fun. Good food. Weather was perfect. We had like blizzards a few weeks ago, and they have heat waves coming. So we got lucky.
They timed it perfectly. Timed it great.
And, yeah.
All right. Well, welcome back, and let's get right into it here. Our first article, BlackRock, the ginormous investment firm, BlackRock $26 billion private credit fund limits withdrawals. And first off, I mean, we're in a day and an age and a time where there's not only a lot of kind of volatility, there's a lot of unknowns out there as well.
Yeah.
And honestly, I can't speak for everyone, but I can tell you personally, there are times like, if you don't stop yourself, you could sit up at night and worry about, your finances, the markets, all these various things, which little selfish plug, but this is why financial diversification is important. But, you're talking, the with this BlackRock fund, this $26 billion private credit fund, investors wanted their money out. And
hmm
it's pretty typical with these type of funds that they have a cap on how much money they allow to come out, which is about 5%. And in this case, the withdrawals that people were wanting to take out total almost 10%, double what it normally is. And the
Yeah.
biggest reason is they cite the fact that they believe that a lot of it has to do with just in the investors getting a little jittery, and they have good reason
hmm
to be jittery. And that's something that it's one thing that you have market vulnerability, but in a manner of speaking, and I don't want to get too far ahead of myself with this, Chris, but like this is in a way kind of, as you read this article, reminisce of like how people when they want their money out of the bank and they can't get it, and then the problems that ultimately creates. Because if you have this happening with this fund, and then as we've already seen some other issues with other funds out there, and it creates that panic, you would find the market could potentially face kind of like a free fall, like a huge drop.
Yeah. I think what's interesting about this too is it shows that in this case they were only investors were only wanting to take 9.3%, it said specifically, of the fund's money out, and the fund said no, you can't do that because that will destroy the fund. We'll be in trouble. And that just goes, I mean, in my mind that's a small percentage, right? 10% of the assets should, you would think, should be able to be liquid and the funds still stay solvent, but they're capping it here at 5%. And I think it highlights that, I think most people don't realize how shaky the financial system can be. And a lot of
Right.
these investments, people invest in a fund like this because they want a little bit better return than what they can get in the traditional banking system. They want maybe better than that 3-4% that they can get elsewhere. But what they don't realize in many cases is that they're also taking on additional risk, and they're also going to limit themselves as far as how much money they can take out when they really need it. And that's
Right.
a big problem in my eyes. Now, again, if investors understand those risks, they're willing to take it. That's one thing. But I think a lot of people invest in these funds and really have no idea what they're investing in a lot of cases.
For sure. And it's not just that. I mean, even if a person is going into it eyes wide open, in
hmm
terms of like they know, what they're getting into, they are still vulnerable. And their vulnerability is the other participants in the fund who may not be aware of all that stuff, like you just mentioned. And the bottom line is that even for that well-heeled, that savvy investor who understands everything completely, If
Hmm.
those people who don't understand are the ones running in to get their money out, it still puts the money at risk. And
That's
not due
right.
to market risk. It's you're talking about people. You're running into risk of people who are requesting basically liquidity. And if you break
Yeah.
down this entire dynamic, Chris, at the end of the day, it's the same thing as what happens when we've had our bank failures in recent years. You have too many depositors. That money that banks have on deposit, it doesn't just sit in a shoebox. The
Right.
banks are putting it, they're investing it, and quite frankly, they're putting it at some form of risk because anytime you invest, there is risk involved. And that's what happens when these banks have these failures, is that the too many depositors are trying to get their money out in short order, and the bank just doesn't have it. And hopefully and thankfully, we have the FDIC until maybe we don't have the FDIC, or if there's a problem with it.
Right.
At some point, the FDIC only has so much money that they're going to be able to bail banks out with, and then the government comes in. I mean, it's a mess. But again, it speaks to the shakiness of the situation. And we're looking at BlackRock. This is not a bank we're talking about. This is an investment firm. So that insurance
Yeah.
doesn't really apply in this case. Now let's go
Right.
going into the next article, kind of related to that, is and again talking about liquidity and talking about the fragility of our financial system. This one out of Daily Reckoning, the title here: Loans to Non-Banks Threaten Banking Crisis. And I had
Yep.
to, honestly, when I read that article, I was like, okay, well, this is weird. I'm going to have to take a little bit of a read into this here, because what exactly are they talking about here? Because it didn't seem like, what why would these two things even be related? Like a loan to a
Yeah.
non-bank. That's just a so okay, fine. That's a sector of the economy where that it's not a bank and they're doing a loan. And as I got into it, it made perfect sense, because what they're talking about here is how, with banks, when they do loans to banks, and for those of you tuned in, if you're not aware, banks do take out loans. The banks have collateral by way of the loans and mortgages and things of that nature that they have on their books. Well, with these non-banks, they're typically smaller businesses, or businesses, I guess, of any size. But in fact, it gets into how Powell said that what you're dealing with is speculative credit and private equity, and he called them schemes, because the banks have, which is kind of weird too. They say the banks, because of regulatory restrictions that they might have, or guidelines, uh, they know what they're dealing with the bank loans. When you get
Yeah.
into these non-bank loans, they don't have those same regulations and those same guidelines, if you will. And that's where that word schemes come in, because people can represent something, and in fact it's something else. And then the other interesting thing they talked about is how, basically, I think this is one where they have the other issue is overstatement or double statement of assets. So basically, they're getting a 2-for-1 loan on the asset, is what part of the problem is here as well. So it seems like a pretty messy situation. Again, it speaks to, again, where there are just these gaps in our economy that could create some real disruption.
Yeah. Well, they're calling these non-bank financial institutions. They're calling them shadow banking entities. And one thing that I think depositors think when they put their money in the bank is that the bank is just loaning that money to other depositors for their car loans and mortgages and credit lines and things like that. And inherently, those are fairly low risk investments. And so people have a pretty good um, understanding that the chances of them not getting their money back are, let's say slim. But these non-bank financial institutions are higher risk companies, and they're making riskier investments, and they can't get loans typically through the traditional banking system. So they get these shadow bank loans. And I think a lot of people don't realize that when they put their money into maybe a credible bank that is fairly secure, that if that bank now lends that money to another entity that isn't as secure, that they're increasing their risk to being able to access their money. And you can see how in the previous article, we were talking about if 9% of the investors want their money back, this fund could go under. Well, the same thing is true in the banking system. And yes, we have FDIC, but in the last 5 to 10 years, I've seen that FDIC has somewhere between 2 to 5% of the deposits out there actually covered in reserves. So if you have more than 5% of the banks fail, or you have one big bank fail that has more than 5% of the total assets under their umbrella, then the entire bank can go under. And again, depositors don't realize that. So this is just another way, kind of like the housing crisis, right? I think it was 2008, 2009, right around there, when they found out that there were all these higher risk mortgages, loans being given out that wouldn't have been under normal circumstances. This is sort of eerily like that, where these traditional banks are giving out loans to companies that maybe would typically not be able to get a loan. They're higher risk, and if that part of the market has trouble, it's going to affect the regular banks that you and I and the average American go bank with.
Correct. And that's just it, is that, let's put it in these terms. Again, based on what we're reading here and by Jerome Powell's comments, even, the average depositor would probably and likely not be comfortable making the type of investment that these banks are. And so
Yeah.
the monies that are being used for this, which ultimately it goes down to depositors, because that's where banks get their money from, is putting people's money in a place where they would rather it not be. And that's
Yeah.
where it really is something that, again, speaks to the absolute need to have diversification in someone's portfolio, so that you're not just you have to keep your money somewhere. So keep some in a
Yeah.
bank, keep some in equities, keep it in property, keep it in gold, silver, various real estate. So where you
Mhm.
have a balance to your investment portfolio, because if you're just, those days of just parking money somewhere and leaving it there, I think are well behind us, for a lot of reasons. One of which being return, but the other of which being, there's a lot of vulnerabilities, and it's easy to say, like, if there's a problem, somebody will be there to bail it out. Well, that's true right up until the point where it's not true, and a lot of
That's
fortunes
right.
over time have been lost, through
Yeah.
the misfortune of a wrong turn in the economy, or a wrong turn in an industry or a sector that carries with it some very serious repercussions. So, all right, Chris,
Yeah.
thank you. For those of you tuned in, if you have not received a copy of our special report, The Secret War on Cash, you can do so by calling us at 1-800-289-2646. You can actually text us as well at that number, 1-800-289-2646, or visit us online at www.swissamerica, all one word, .com. You'll see the phone number as well as the web address, in our show description. And if you're not subscribed to our channel, please do so, as we'd love to talk to you more in the future. Other than that, thanks for tuning in. Have a great rest of your day, and we'll talk to you real soon.
Take care.